Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial conditions.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Tuesday, December 9th. We're doing kind of a special update. Generally, these videos are on Monday, Wednesday, and Friday, but we had a WASDE report today, so wanted to do a recap on those numbers as well as where that leaves us on the charts. Typically, this December report, really much ado about nothing, not a whole lot of significant changes or market-moving information, but there were some silver linings, certainly for the corn market in today's report. So without further ado, we'll just jump right into things. Here we got the March corn futures pulled up. As you can see, higher on the day, 4 1/4 cents higher, settling at 4.48. That's about 3/4 of a cent above the 200-day moving average. Last time we got to close above the 200-day moving average, we fell flat on our face the next day. So some follow-through is really what the bulls want to see, not just above the 200-day moving average, but above the top end of this range, which really goes all the way back to September, and that comes in near that psychologically significant 450 level. If we can get some follow-through and a conviction closeout above there, wouldn't be surprised to see these mid-November highs retested and potentially taken out. That comes in at 457. So a nice friendly report, hopefully get some follow-through and a nice tailwind for a potential Santa Claus rally into the end of the year. So what was the report that gave us a little bit of hope into the end of the year? It was a U.S. balance sheet ending stocks 118 million bushels below the average analyst's estimate and 125 million bushels less than the prior month's report, which I think is the second largest reduction in this December report in about 20 years. So certainly a friendly number there that can hopefully give us a breakout to the upside. World ending stocks for corn at 279.15 million metric tons, also below the average analyst estimate, which was 281 million metric tons. So some things to be optimistic about in the corn market, but again, it's all about follow through and technical momentum here as we enter the midway point in the week. Now over to the soybean market, bearish head and shoulders. We've been talking about this for the last couple of weeks. Technical breakdown, and now we're back in this box, which we've outlined for the better part of the last couple of weeks as the first major downside target. This was the original breakout point from October 27th. As you can see, prior to that, it was resistance in August and June and May. So we're back to resist. Old resistance is now support. A break and close below here, and you're looking at a gap fill from that October 27th breakout point. That's another 20 cents lower. With that said, I really wouldn't be surprised to see these areas hold as key support going forward. But we'll see how the next couple of days go. Should be pretty crucial in kind of setting the tone into the year. But I think if this doesn't hold, we'll kind of make our way towards that gap. I would suspect that would be pretty darn solid support. Knock on wood. What the USDA did there, absolutely nothing. Basically left everything unchanged. So again, it was much ado about nothing for the soybean market, and it was more about technical weakness and momentum controlling today's price action on that front. South American production numbers also left unchanged. So not a whole lot to write home about in that soybean market. We're obviously quickly turning back to focusing on whether or not China is going to continue to buy soybeans and if they're going to accelerate those purchases or not. We're also going to keep a close eye on South American weather, which we are updating on our South American portal at bluelinefutures.com, so you can go check out that information there. Now, over on the wheat side of things, it's just another day. We're just trading along this 50-day moving average for about 3 weeks straight now, defending the low end of the range, which I think is, a silver lining, certainly, 528 to 530. That's been tested and held multiple times over the last several weeks, but the bulls still got their work to do. We got to get out above technical resistance, the top end of the range, and these two moving averages. The blue line is the 100-day and the purple is the 20-day. That resistance comes in 440, 444. We need to see consecutive closes out above there to get really some technical momentum building. Until then, it's kind of like watching paint dry, so not a whole lot of exciting price action in the wheat market. Hopefully we can get some sort of excitement, even if it's a breakdown to the downside. Just some sort of movement other than sideways would certainly be nice to see and make things a little bit more exciting in that market. Now, jumping over to the livestock side of things, we've been talking about it, volatility shriveling up and ranges shriveling up and coming into a range-bound trade, and that's exactly what we've seen over the last two sessions as the market stalled out at the 50% retracement, which again is just a fancy way of saying the middle of the range from these October highs to these November lows. That also has the 50-day moving average, the 100-day moving average, and then the gap. So ultimately, I think we settle into a range, and that range might span from, call it 220 to 232 on the top side. So although it might be a wide range, I wouldn't be surprised to see it be that range here into the end of the year. Cash trade obviously going to be watched very closely, but a lot of people kind of talking about, oh, we're going back to the highs, or oh, we're going back to the lows. I really think the pain trade would just be a sideways trade here. I think a lot of the froth has been wiped out of the market. We start to see volatility subside. We can see that taking place in the CME CVOL index, which again declined for live cattle and feeder cattle today. That volatility index in live cattle is at the lowest point since November 3rd. So that volatility is coming in. If you had bought options over the last couple of days thinking that we're going to make big moves, you're probably not doing too well on those. The volatility is coming in, and I wouldn't be surprised to see that continue to be the trend. Now, over on the feeder cattle side of things, same type of deal. Coming into a nice little range, we hit overhead resistance, 50% retracement, as well as the two major moving averages, the blue line, the 100, the red line, the 50. That's also the gap. If we were able to get out above 340, maybe that would spur some additional technical momentum up to fill the gap, or at least work its way into the gap. The lower end of that gap comes in close to 348. So even though I think we settle into a range here, that's the risk. If we get out above 340, there's some air until 348. So knowing where the risk is really important, especially in these cattle markets, which can move very quickly and on short notice, certainly. Now, wrapping things up, lean hogs tested and failed against the 50-day moving average. Just can't chew through that. I'm still optimistic that we can get out above there with some time. The weakness really came in that first 5-10 minutes of trade, but then kind of rallied back and tried to find its footing, which it ultimately did to close off the lows, even though it was lower on the session. Need to get out above that moving average as well as these November 11th highs. That comes in near 87 for that April lean hog contract. If we can do that with consecutive closes, I think we could see some additional technical momentum towards 88.70 to 89. So that's what we're looking at. If you have any questions at all, do not hesitate to reach out. Our trade desk is always ready, willing, and able to help. So give us a call. And again, remember, trading futures and options does involve substantial risk of loss and is not suitable for all investors.